spend some time on this slide. And this is the reassessing, let's say, of the portfolio. And you will see we subdivided into Tier 1 assets, Tier 2 assets, and other. Starting with the Tier 1 that are self-explanatory, but you can see 1.7 million ounces of production a year at total cash cost of $940, all-in sustaining of $1,200. So that would situate you along the, let's say, first quartile of big assets in the world in all metrics. It accounts for 80% of the EBITDA of AngloGold and 75% of the mineral resource. So long life and very competitive assets. Let me go over each one quickly. So Geita is performing well. We did have an issue in the first quarter, just a scheduled maintenance, but we expect to make it up. So if you look at H2 production, we expect to be roughly repeating what we did last year. Last year in H2, we did around 300. We'll do probably a little bit less than that, but it will skew hence in Geita to a 40-60 production. We've done it before. We will do it again. That will have important impact in lowering our cash costs and keeping our cash cost guidance, as I'll talk about it later. Obuasi, we started with, that will also have like a 40-60 split, probably a bit even more skewed. We did about 120,000, and we are saying, and we're planning to do 180,000 in the second half. Last year we did 160, but last year we were at that time being able to hoist about 4,000 tons per day from the mine up, let's say up from the underground. Right now we're up to 6,000 tons per day with much more flexibility. So the team on the ground and we all, the corporate team, are confident that we'll be there or thereabouts in Obuasi. What does that do to cash costs again? If you take the first half and compare it to the second half, just by the sheer size of production, and the fact that about half of the costs are fixed, half of the costs are variable, that would decrease cash costs in Obuasi by a significant amount in nominal terms and real terms, by about $160. If you take then Kibali seeks to repeat what it did last year of 180,000 ounces. So again, better production H2 to H1. Iduapriem, we also expect about 14,000 higher, and Tropicana similarly. So that completes the Tier 1 assets that are the cornerstone of the company in the very near future. Then you have the Tier 2 assets. Those are the ones where probably they'll be run more for cash. They will come in second in the rank in terms of new capital. The Tier 1s probably will have priority, but we will still obviously nurture them with sustaining the necessary sustaining capex. You start with Sunrise, and that's an interesting one. It was the first asset that we started the full asset potential. And I've always been sort of reluctant to put a number to those programs because you hear a lot of companies saying we did 500, we did $1 billion, but then the profits never change. In the end, what matters is the bottom line, and that's what we are talking about you today. The cash, we expect the cash cost of Sunrise to go down by more than $100 an ounce this year, and you already see that in the Q2 results. So we're quite happy that it's not the only reason, but clearly a significant impact of the full asset potential on Sunrise. Siguiri, it was an issue. We lost about 25,000 ounces because of the tank collapse. The team on the ground did a magnificent job in putting it sooner than we all expected, and we're now right back to normal operations. The metallurgical recovery is a bit lower than usual, but as we bring in the 2 new plants that are finalizing repairing, it should go completely normal. But production is normal, so expect to see again a better second half versus first half on Siguiri. Cerro Vanguardia will be probably similar, and Cuiabá. So Cuiabá, we're quite happy. We will exceed the outlook on production. It is covering not only its operational costs, but it's also covering all its sustaining capex in the second half. So we basically now stabilize into, let's say, 120, maybe 140 to 70,000 ounces of, so 2-to-1 ratio of concentrate to gold production, and the operation of concentrate is moving quite well. And so it is not, it lost money in the first quarter because we couldn't export any concentrate, But as we now normalize it, we are also expecting a much better second half. And then we have the other ones. The other ones, we've said before, by scale, they don't belong in a portfolio like AngloGold, but we are still responsible stewards. We want to obviously make sure that they are handled in the best possible way. They are very high in the cash cost, and they are causing a significant drain and loss of competitiveness. So that's why they are in other. In CDS, what we've said is it's a complex mine, and at some point this year we'll take a decision. We'll try to sell it as we did before, and if we can't, we will take other decisions like putting it in care and maintenance. No decision has been taken, but you shouldn't expect it that it's part of the AngloGold portfolio in 2024. Sierra Grande is different. Sierra Grande, we expect it to be cash positive in the second half. It was slightly negative in the first half, but it's small in nature. If at some point in the future we can find a good home for it, we will do, but there's no urgency on Sierra Grande because it's, as I said, we don't expect any losses in the second half. It's back to, let's say, to covering for its own cost and sustaining capex. So that's our portfolio. Let me probably say one last thing. In Brazil, we devoting a lot of resources like we should to what has been a significant issue in the company. Our acting CEO, Marcelo, is over there. We have a new head SVP, Marcelo Pereira. He comes from a lot of gold experience and Valley. He will be the SVP, let's say, the head of all of the Americas, eventually including Nevada. So he will be a good steward on Brazil to do this in the best, safest, and best way. We have been a long time in Brazil, and we will do things like we always do in the right way. And we also have a new finance team, and so we're giving them all of the support and a lot of resources in this transitional period. Let me talk about our commitment on renewables. We entered into an agreement with Pacific Energy to construct and operate 62 megawatts of wind and solar generation capacity at the site. Pacific Energy will construct a renewables project and continue to operate the combined renewables gas power station under a 10-year purchase power agreement. Once complete, the project is expected to deliver a 50% reduction in overall natural gas consumption. The capital cost of constructing the renewable infrastructure will be incorporated into the ongoing power costs charged to the Tropicana JV partners. The project is designed to maximize the emission reduction while maintaining power costs at current levels. The project is due for completion in early 2025, with on-site construction expected to commence in the second half of this year.
Let's first take a look at the macro environment and its impact on our business. Gold price closed in Q2 at around $1,920 an ounce, up about 8% year to date, with price received in the first half up 2% year on year. We have 135,000 ounces, or just under 5% of our production, hedged with a zero-cost collar option, with a floor of $1,950 an ounce and a ceiling of $2,029 an ounce. And this is essentially in place to protect the downside of price risk at our Brazilian assets. On inflation, we do see some easing, albeit significantly higher than the same period last year, specifically in some of our key jurisdictions. So you can see there, Ghana, Guinea, Argentina, and even though Australia has come down slightly, still very high, and particularly in Western Australia where we operate. You may recall we anticipated 6% inflation for the full year of 23. We're currently trending at around 9%, as Alberto mentioned, and this has impacted our cash costs by $98 an ounce on the half. In currency, we do see continued weakness in the Aussie dollar, the Argentinian peso, the Ghanaian cedi, and this improves our cash cost by $48 an ounce. Oil price, as all of you will know, has continued to come down across the year. We have a hedge in place for about 40% of our consumption at $89.20 a barrel. and a realised loss of $5 million year to date. We look at the key financial highlights. We ended the first half of 23 with revenues of 2.2 billion, up 3% from the first half of 22. Adjusted EBITDA was 678 million in the first half versus 864 million for the first half of last year. This is mainly due to increases in inflation, as I mentioned, higher operating costs, higher investment in exploration and evaluation as we've planned, and then environmental provisions related to new legislation in Brazil, as well as legal and project fees related to our corporate restructuring. This is partially offset by higher gold sold and the higher gold price. H1 headline earnings were 139 million or 33 US cents per share, compared with 300 million or 71 cents per share in the first half of last year. Net cash inflow from operating activities was 293 million versus 992 million year on year. Remembering that half one of last year benefited from the release of the 460 million cash lockup in Kibali. After accounting for growth capex and corporate-related expenses, we recorded a free cash outflow of 205 million for the half. Adjusted net debt of 1.2 billion was 454 million higher year on year and reflects 217 million of dividends paid and 150 million for the acquisition of Nevada assets. Adjusted net debt to adjusted EBITDA was 0.74 times at the end of the half, below our through the cycle target. We've declared a dividend of 4 US cents per share on the back of our improving costs and production profile through the remainder of this year and our commitment to generate positive cash flow performance.